Imagine turning a $450,000 stock windfall into a $450,000 charitable gift and saving tens of thousands in taxes at the same time. Sounds like financial wizardry, right? By the end of this video, you'll know exactly how Matt and Veronica unlocked this tax-saving superpower and how you can too. Stay tuned because your next big charitable move could be your smartest ever. Matt and Veronica held tech shares that soared from $300,000 to $450,000. Naturally, they wanted to give the full value to a wildlife rescue. Their first instinct? Sell the shares, pay the tax man, then write a check. But after talking to their advisor, they discovered a strategy that would let them donate more money and keep more of their gains. Frustratingly simple, yet most people never hear about it. Here's the roadmap. First, learn why you should never sell an appreciated asset destined for charity. Next, see the jaw-dropping comparison of selling versus donating stock directly. Then, explore the power of a donor-advised fund to supercharge your giving. And if you stick around until the end, I'll share the secret to bunching contributions for maximum tax impact. What if you could bypass capital gains taxes entirely and still claim a deduction on the full market value? The key is donating the asset itself, in this case, those tech shares, directly to a qualified charity or a donor-advised fund. That single move creates a double-dip tax benefit. Let's compare two approaches. In scenario A, the inefficient way, Matt and Veronica sell their $450,000 of stock, realize a $150,000 gain, and owe 23.8% in taxes. That's $35,700 out of their pocket before they even write a check. They end up with $414,300 to donate. In scenario B, the clever way, they transfer the shares directly to a donor-advised fund. The fund sells tax-free, so the full $450,000 goes into the charity's coffers. Plus, they enjoy a charitable deduction for the entire fair market value. They've dodged that $35,700 tax bill and boosted their gift by the same amount. That's the double dip in action. But we're not done. Enter the donor-advised fund, the supercharger of this strategy. A DAF acts like an investment account for your philanthropy. You contribute appreciated stocks, mutual funds, or ETFs and take your deduction right away. The DAF can sell the assets tax-free and invest the proceeds, letting your contribution grow over time. When you're ready, you recommend grants to your favorite charities on your schedule. There's more. You can bunch multiple years of giving into one large contribution, jump over the standard deduction threshold, and itemize for a monster tax break in that year. In later years, you revert to the standard deduction while still making grants from your DAF. You get a single tax receipt, simplified record keeping, and even the option to give anonymously. So what should you do next? First, inventory your taxable brokerage accounts and pinpoint any long-held appreciated assets. Second, open a donor-advised fund with a major sponsor, Fidelity Charitable, Schwab Charitable, Vanguard Charitable, or the like. Third, transfer those appreciated securities directly into your DAF instead of selling them for cash. Fourth, consider bunching several years of planned gifts into 1 year to maximize itemized deductions. This strategy isn't a loophole, it's deliberate tax policy designed to encourage generosity. By donating the asset itself, you eliminate the friction of capital gains tax and supercharge your gift. That's how you turn a stock market win into a massive charitable impact. Ready to transform your next donation? Hit like if you found this eye-opening, subscribe for more savvy money moves, and drop a comment. What causes are you passionate about? I'll help you make your giving go further in the next video. Thanks for watching.